who's bidding on what's left of Silicon Valley and Signature banks. But we begin with our floor show traders, Keith Fitz-Gerald and Scott Redler. Keith, on top of everything else, it is Triple Witching Friday. That's the expiration of all kinds of options and futures, sometimes ramps up even more the volatility that we're seeing. Why isn't the Bank Coalition's lifeline that came in officially during this hour yesterday, lifeline to First Republic, why isn't it keeping First Republic and the rest of the markets afloat?
Because of the way our banking system works, Liz, that's a very important question. There are rehypothecated debt, meaning all the deposits are relent. It's a rush to find out who's got the last real dollar in the system. Nobody simply wants exposure. They're walking away from the bid. They're going to let it settle. But this reminds me of 2008. Many of these big traders are deliberately walking away because they believe there's going to be a bailout. So they're looking to do some bargain hunting. It's market mechanics at its very best and worst, unfortunately.
Okay. Scott, you want to talk volatility? All we have to do is look at the 5-day picture this week alone of the Dow Jones Industrials and the point gyrations. Obviously, after both Signature and Silicon Valley Bank failed over the weekend from Friday to Sunday, we started to see the Dow respond negatively. And we can put up what each point day actually did. And then as headlines started to come in about the FDIC guaranteeing all deposits, not just uninsured, not just insured deposits. Again, you had the gyrations from day to day for the Dow Jones Industrials. So my question to you is, what happens, at what level do the algorithms start to kick in and suddenly begin to either buy stocks on the dip, it's a pretty big dip, or continue to flee?
You just said a lot, and there's a lot of unanswered questions. Right now, when you have so many questions and not a lot of answers, I think, like you said, the big money stays on the side. And like Keith just said before, he kind of correlated this back to 2008. Like, there was a lot done to try and shore up confidence for the banks, right? And the Dow has been under pressure all week, but there's been a head-scratching divergence between the Dow and the NASDAQ. So the indices don't look as bad, but underneath the surface, there's a lot of bearish action. You're seeing Bank of America at lows, 2022 lows. That could be a problem. People are saying Credit Suisse is going to be worthless as an equity, same way with most of these regionals. But meanwhile, the S&P is about 12% off the October lows. So you're asking me for a level in the S&P that the algos kick in? Well, Monday was 38.08. That's all we know. I traded through the financial crisis, and every time we had a bounce, I would look to see what didn't bounce, to see what the next problem might be. And we tried to bounce this week. Tech rallied. The banks didn't, with all of that going on. So if JP Morgan, I would watch that, Liz. If JP Morgan continues lower and tries to catch up to Bank of America, that Dow is not going to find buyers. 38.08 in the S&P cash is not going to hold. And then the strength in tech
I keep hearing that, Scott. I keep hearing we're going to go back to 3,000. We haven't even gotten close to that. We're at 39.10 right now for the S&P, but we've got all of these financials that are really struggling. Bank of America down 4% right at this moment, and we should keep cycling through those Western Alliance headlines that hit right before the top of the show that don't seem to be working. Stock is still down about 10% to 33.24, even after this regional bank out of Arizona is saying, no, we're good. We've got a lot of cash that we're able to immediately access, 20 billion plus. And so let me take it back to Keith. Keith, you're saying stay sharp in this last 52 minutes of trade because anything could happen. But is there an opportunity, or are you just saying, you know what, I'm staying away?
No, actually, I'm always on the hunt for opportunity because it's days like this, Liz. You know, you embrace the bear. Yeah, it's scary. Yeah, you may get a few claw marks. But you know what? There's going to be outliers on sale. We're seeing Apple, Microsoft, those things respond. We're seeing NVIDIA respond. The tech that was such a wreck last year is the safe haven because people believe in it. They can touch it. They can use it. Big banks, those are an enigma right now. Nobody knows what happens. You throw all your money in there and you never see it again. It's not like the old days where you count your cash in the machine in the lobby. That just doesn't work. So I think there's a crisis of faith much more than there's a crisis of banking. But as a trader, this is the kind of stuff you live for because this is where you find the bargains. Maybe not today, but Monday or Tuesday, I'm definitely going to be looking for some buys.
Scott, we can't ignore what's going on in bond land. We've got 10-year yields at 3.4%. they're down. All of the yields actually are down at the moment, depending on which part of the curve you're looking at. And the 2-year yield is at 3.86%. Okay. So it is actually slightly above, about 26 points above the 10-year. So we still have that yield curve inversion. Tell me what you think about what's going on in the Treasury world and what signals you get from these movements about the equity picture.
Well, the signals keep changing. We started the year, everyone said we're going to have a hard landing. Then they went to a soft landing. Then they went to a no landing, and now we're back to a hard landing. The ceiling, by the way, was just at 5.7%. And the duration was at 5.1, and now it went down a point. So the bond market, saying we're going to go into a recession, but the equity market is still 12% above last year's lows. That's why traders are pulling their hair out. They don't know what to believe. So we're trying to look at the action, and the action right now is showing you so many mixed signals that as an active trader, you take your trades fast. As someone who wants to put money to work, you might as well wait unless you put monthly funds in, because this probably won't be the low of the S&P. And I know a lot of strategists are saying it should have happened already, but sometimes a dribble turns into a waterfall. So we're going to see what the Fed does next week. I think they do a quarter. They have to continue to fight inflation. I think the street has it wrong where they think they're going to cut 2 or 3 times, because that's what they're showing for the duration, unless we get a really big breakdown in the S&P, which means more things are breaking than just the regional banks.
Fed meeting is on Wednesday of this coming week. And, I'm telling you, we had our Fed funds futures right at the top of the show, and a pause, 31% odds of a pause. It has now jumped between the time that we looked at it, 31% thinking there would be a pause, to now 38%. So again, as Scott said, traders and investors, I'm sure, are tearing their hair out, but this is a moving target. And we're going to end with Keith Fitz-Gerald saying, stay sharp this hour. Yes, that is now out of date, folks. It should read 38%. Thanks to Keith Fitz-Gerald and Scott Redler.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.